Two dividend ETFs, same amount of money, same 12 months. One of them put $932 more into your account on every $10,000 invested. And here is the part that trips people up. The fund that made you more money was not the one with the higher yield. Not even close. Today, I'm going to show you the exact numbers behind that gap. You're going to see what a higher yield actually costs you inside your growth bucket. And by the end, you will know exactly which fund earns its place in a retirement portfolio built to last. But there is one piece most people never look at, and it is the reason that gap exists in the first place. I'll get to that in a minute. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. If you are somewhere in your mid-50s or early 60s, you've probably had this moment. You look at two funds side by side. One pays monthly at close to 5%, the other pays quarterly at around 3%, and your gut says, go with the bigger number. That instinct makes total sense, but today I'm going to show you why that instinct can quietly cost you thousands. So let me start with the number everyone looks at first, the yield, and let me show you why it's telling you a half-truth. The yield half-truth. Here's the myth. A higher distribution yield means more money in your pocket. Here's the truth. Yield is one number. Total return is the number that actually grows your retirement portfolio. Let me put real numbers on that. SCHD, the Schwab U.S. Dividend Equity ETF, currently yields around 3.1%. It pays quarterly. It charges an expense ratio of 0.06%. That's $6 a year on every $10,000 invested. DIVO, the Amplify CWP Enhanced Dividend Income ETF, has a trailing yield closer to 5% on a normalized basis. It pays monthly, and it charges 0.56%. That's $56 a year on the same $10,000. So right away, DIVO costs you $50 more per year in fees on just $10,000. Scale that to $50,000 and you're paying $250 more every single year. SCHD costs you $30 a year on $50,000. DIVO costs you $280. That's a $250 difference, and it compounds against you every year you hold it. Now, if DIVO delivered significantly higher total returns, that fee might be worth it. But here is where the story flips, and it has to do with something built into the way DIVO makes its money. Think about it this way. Have you ever looked at two funds and picked the one with the higher yield without checking total return? A lot of people do, and it's a completely natural instinct. But once you see what's happening underneath that yield number, you'll never look at it the same way. The covered call ceiling. Here's the thing most people never hear about DIVO. It doesn't just collect dividends from its stocks. It sells something called covered calls on some of those holdings, and that strategy is the reason its yield looks higher, but it's also the reason its growth gets capped. Let me explain it simply. Say you own a stock worth $100. You sell someone the right to buy that stock from you at $110 by a certain date. In exchange, they pay you a small cash premium right now, maybe $2 or $3. If the stock stays below $110, you keep the premium and the stock. Free money. But if that stock shoots up to $130, you're forced to sell it at $110. You just gave away $20 of upside for a $3 premium. That's the covered call trade-off in one sentence. You get cash now, you give up growth later. Now here's the important detail. DIVO doesn't just write calls on every single position. It's selective. The managers pick their spots. They typically have calls on somewhere between 7 and 20% of the portfolio at any given time. That means DIVO captures roughly 75 to 85% of market upside in a good year. It doesn't give up everything, but it does give up that top 15 to 25% on the positions where calls were written.
And in a strong bull market like the one we have been in, that missing slice adds up fast. Think of it like a ceiling on your growth. SCHD has no ceiling. Every dollar of upside belongs to you. DIVO has a ceiling that lowers itself every time a call gets exercised. So you now know two things. DIVO costs more in fees, and it has a structural limit on how much it can grow. So what does that actually look like in real dollar terms? The total return math. This is the chapter that matters most. Over the past 12 months through mid-2026, SCHD delivered a total return of roughly 24 to 29% depending on the exact window. DIVO came in around 15.7%. Let me think through what that means for real money. Say you had $50,000 a year ago. You put it all in SCHD. At a 24% total return, and I will use the conservative end, you now have $62,000. Same $50,000 in DIVO at 15.7%, you have $57,850. That is a gap of over $4,000 in 1 year. SCHD put about $12,000 back in your pocket. DIVO put about $7,850. That is over $4,000 SCHD earned you that DIVO did not. And remember, DIVO was paying you monthly the entire time. That monthly check felt like income. It was real money hitting your account. But when you step back and look at total return, price growth plus all distributions combined, SCHD still came out well ahead, even though it only paid quarterly, even though its yield was lower. Here is the line I want you to remember. The monthly check felt like a raise, but the total return was the real paycheck. Now, let me be fair. 1 year is 1 year, so let me zoom out. Over 5 years, DIVO actually performed about the same as SCHD on an annualized basis, roughly 10 to 11% per year for both. And since DIVO launched back in December 2016, the two funds are running nearly neck and neck, about 13.5% annualized for SCHD versus 12.6% for DIVO. So the long-term story is closer than the recent story suggests. But here's what changed. SCHD went through a major reconstitution in March 2025. It shifted heavily into energy. ConocoPhillips became a top holding. Energy went from about 12% of the fund to 21%, and that move turbocharged the next 12 months. Then, in March 2026, SCHD reconstituted again, added United Health and Qualcomm, trimmed energy back down. So the composition keeps evolving, and right now that evolution has SCHD running well ahead. Quick question before we move on. If you hold either of these funds right now, which one is it? SCHD or DIVO? Or maybe both? Drop it in the comments. I read every single one. So SCHD wins on total return, lower fees, and uncapped growth. But there's one more angle most comparison videos skip entirely. And for anyone over 65, this might be the most important part of the whole video. The tax angle nobody covers. Here's something that surprised me when I dug into it. SCHD's distributions are almost 100% qualified dividends. That means they get taxed at the lower long-term capital gains rates, 0%, 15%, or 20% depending on your income. DIVO is a different story. Its distributions are a mix. You get some qualified dividends from the blue chip stocks it holds, but you also get option premium income, which is taxed as ordinary income at your regular rate, and a portion comes back as return of capital, which lowers your cost basis instead of being taxed now. That sounds complicated, and it is, but here's the simple version. If you hold SCHD in a regular brokerage account, almost everything you receive is taxed at the lower rate. If you hold DIVO in that same account, a chunk of what you receive gets taxed at the higher ordinary income rate. That can be the difference between 15% and 22% or even higher on part of your distributions. Now, for anyone already on Medicare, there's another layer. It's called IRMA. That stands for Income-Related Monthly Adjustment Amount, and it's a Medicare surcharge that kicks in when your income crosses certain thresholds.
For 2026, those thresholds start at $109,000 for single filers and $218,000 for married filing jointly. And here is the catch.
IRMA uses your income from 2 years ago, so a big distribution this year could raise your Medicare premium in 2028. DIVO had a large special distribution in December 2025, almost $1 per share. That kind of lump sum can push you into a higher IRMA tier 2 years later without you even realizing it until the bill shows up. SCHD does not have that problem. Its distributions are steady, predictable, and almost entirely qualified. So for anyone over 65 holding dividend funds in a taxable account, SCHD is the cleaner choice from a tax perspective. And that is something most comparison videos do not even mention. Now, I said I would be fair, and I mean it. DIVO is not a bad fund, not at all. It is built for a different job. In 2022, when the market dropped hard, DIVO held up better than almost anything in this space. Its total return stayed close to flat, roughly negative 1.5%, while the S&P 500 fell around 18%. That covered call cushion and those monthly premiums did exactly what they were designed to do. They softened the blow. So if your primary goal is steady monthly income with less stomach-churning volatility, DIVO earns its seat. It belongs in an income bucket or a defensive sleeve, not the growth bucket. And honestly, if you're already retired and pulling from your portfolio to cover expenses, a fund that smooths out the ride has real value. Sequence of returns risk is no joke in the first 5 years of retirement. But if the question is which fund grows your money faster over time, and that's the question this title promised to answer, the math is clear. Let me walk through that. Expense ratio, SCHD wins, not even a contest. $6 versus $280 on $50,000. 1-year total return, SCHD wins by a wide margin. 5-year annualized, basically a tie. DIVO edges ahead slightly. Holdings and diversification, SCHD with 103 versus DIVO's 33. More names means less single stock risk. Tax efficiency, SCHD wins. Almost everything is qualified. DIVO's mix of ordinary income and return of capital creates more complexity and potentially higher taxes. But yield and monthly income, DIVO wins. If you need a bigger check more often, DIVO delivers that. And downside protection, DIVO wins. The covered call cushion genuinely helps when markets drop. So here's how I see it. For the growth bucket of a retirement portfolio, the part of your money that needs to compound for the next 10, 15, 20 years, SCHD is the stronger choice. Lower cost, higher total return, cleaner taxes, more diversification, no ceiling. For the income bucket, the part that needs to send you a monthly check right now, DIVO has a case, a real one. Smart investors approaching retirement know this. The answer is not which fund is better, the answer is which fund goes where. And here's the line I want you to take away from this. A higher yield is not a higher return. Total return is the real paycheck. Know the difference and you're already ahead. If someone you know is choosing between these two funds or chasing yield without checking total return, share this video with them right now. It might save them thousands. What about you? Where would you put SCHD and DIVO in your portfolio? Growth bucket, income bucket, or somewhere else? Tell me in the comments. If you're building income from your investments and want to stay ahead of changes like this, subscribe to this channel so you don't miss the next one.